This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me this morning Charles Hugh Smith, well-recognized writer on the web, who is the publisher of the website Of Two Minds. Good morning, Charles. Welcome back to Macro Analytics.
Thank you very much, Gordon. Very glad to be here.
Charles, I've got a number of slides I'd like to jump right into. I call this session the window of opportunity blown. I can see by your writings it troubles you, but it's certainly been troubling me. And this opportunity we've had for our governments around the world to fix problems and really haven't fixed the problems. And it leads to three real big questions that I'd like us to spend some time on. But in a way of background, we've got these canaries in the coal mine that have been singing. We know the EU problems that are going on, and we're into a serious recession there. The U.S., I believe, is in a recession or very close to it. Emerging markets are now feeling problems that they haven't felt before. Money is being repatriated in significant ways. We've talked about the Japanese problem and Abenomics and what we're seeing there. And now, more recently, with the Shibor and the interbank freeze that's going on in China, it's now appearing there. So we've got these global problems that are only getting worse, and we haven't come up with any resolution to them. And we've had the major institutions around the world that follow these sort of things, the World Bank, the International Monetary Fund, the OECD, the Bank of International Settlements, just absolutely, and I'll use the word screaming, Charles, because that they're saying that the world has become too dependent on central bank monetary policy and it's out of runway, that the problems have to be fiscal and public policy to address structural problems in individual countries and, frankly, globally, and nobody's doing anything about it, and something must. And they've been saying this for at least 18 months, but in the last month, and I published a fair bit on what they've been saying, I mean, they're using language that I haven't heard in a long time. If we're running out of runway with these problems that have existed since the financial crisis, and as we both know, were there before it and caused it, we've got the new problems, and I'll just pick on one that you and I call the untouchables. We have 75 million baby boomers in the United States that are now retiring, and we have an $84 trillion unfunded liability here with these programs that we're not talking about and not addressing, that we have to overlay onto these problems. We have $3 trillion in unfunded pensions at the federal, state, and corporate levels that nobody knows how to fund with interest rates this low, and even though they've raised up here recently, still so insignificant. What are we doing about that? And what are the realistic options to it? So it leads to these three questions that I have up here. And I'll pose it to you to take a kick at it first, but are we entering our market clearing event? Or does the government have another quiver in its sling? We did a show on, for those our listeners that may not be familiar, on a market clearing event. But are we there, Charles, or do you think the governments have another shot at this to do something?
Well, Gordon, I would start my response by covering a couple of points about why have they blown this window of opportunity. And one of them is that they've expanded credit and liquidity as the solution to recession, because that's what works, and that's what's worked in the past for run-of-the-mill standard business cycle recessions. So they've done more of what used to work, but it's no longer working, and they've had a failure of imagination to recognize that it's not going to work for the reasons that we've often spoken of. The other thing that I would want to mention is the political leadership is doing what's politically expedient. They're not really thinking through the consequences of their actions. They're just doing what's kind of quick and dirty and politically painless for them. And we can ask, why are they doing this? And I think one of the answers is the vested interests are too powerful. And this is a result of centralization of wealth and power, which leads to corrupt democracy. And I realize that's we're going to discuss that in a second. But these are the three drivers, I think, of why we are heading for a market clearing event. That the policies are based on past, which is not a good guide to the present crisis, and in vested, politically expedient policies are not the answer. They're just leading to a series of unintended consequences that make the problem worse. And then centralized wealth and power have corrupted the feedback mechanisms that would have in the past allowed us to respond to crises.
Well said, Charles. I think you summarized it quite well. A chart I have up here, another way of looking at it, these policies that, because as you said, sticking to policies that don't work and expanding money supply has been primarily the only option that we've come up with. Print more money from whatever the central banks were, whether it was in the United States, the EU, Japan, whatever. And what I have here is something that may help with the problem that they've got themselves into. And the top shows the S&P 500, the U.S. stock market. And then on the bottom is showing the global stock market without the U.S. corporations in it, the Morgan Stanley measurement. And you can see they're clearly two completely different charts after the 2007-2008 financial crisis. And part of the problem has been not just to try and return the United States and developed worlds to put it into a proper recovery, but to also make sure that the rest of the world was able to recover. And you and I did a show on the Triffin paradox, and in fact how one person's surplus is another person's deficit, and how this unfortunately around the world has forced the developed countries of the United States to have a deficit to allow the others to work or to grow. At least that was the thinking back in the 90s. So in that context, when we had extend and pretend, which was a U.S.-centric problem at the time to resolve the housing collapse and the U.S. problems associated, it was a regulatory kinds of policies that we went in, and I say that we changed the mark to market on the bank books. We looked the other way in some of the regulatories, how assets were treated, played games with tier 1, tier 2, but it was a lot of accounting things associated with the United States. But quickly it worked, but it helped around the world, as you see on the lower chart. But then Europe blew up, and it became a sovereign problem, and we all know it. And I used to call it kick the can down the road, and it helped sort of stabilize Europe, at least on the surface. I will call paper it over, but it didn't help the rest of the world. It was starting to weaken. And then, since last fall, we've had Japan signaling Abenomics before the election and dramatic run-ups in the Nikkei, etc. But now it's backfiring, and it's created more volatility. But these problems have rolled through the G8, and now we're facing China and a new set of problems. And all of this is being fostered into having to print more money in a broader base, and it's not working, and it's failing miserably. And one of the reasons, and clearly we've talked about this many times, is printing money's not the answer. And some brilliant work done by Charles Gav of GavCal in Hong Kong shows that because GDP isn't related to wealth, or very indirectly, and wealth growth is going negative. So where the equity and the assets and the collaterals are imploding, and printing more money does not fix the problem.
These are two terrific slides, and I think that the underlying dynamic they're showing is that loading up on debt and liquidity doesn't generate growth. And that's, as you say, that's the one policy answer that the status quo system has, which is to increase credit and debt and throw more liquidity into the system. And what the unintended consequence of that action is, they've allowed an enormous expansion of negative trends, like the misallocation of capital. Throwing around trillions of free money has enabled asset bubbles and gross misallocation of capital into very risky risk-on trades. And once you load up on debt as a solution to growth, there's a funny little thing called interest, which piles up. And now what you've done is by creating these expanding debt is you've created a situation where the slightest increases in interest will destabilize the entire system. And that's, I think, part of what we're seeing now.
In Japan, the debt is 23 times the tax revenues for the country. And so if, in fact, interest rates go up by 1%, the tax revenue can't support it with the size of the debt it's at. And will that happen? Well, the stated policy of the government is 2% inflation within 2 years. And if you get 2% inflation from where it is now, bond prices will go up at least to reflect that increase, and there's your 1% or more. And so you have a policy that by just simple arithmetic is doomed. Now, what possible thinking is there to put your country onto that trajectory unless they have no choice? And in many ways, Charles, to be fair, the central banks really have no choice, and that is because how money is created. Money can only be lent into existence by the nature of how money is created. So when you have $220 trillion worth of assets and $150 trillion and more is debt, and 71 trillion of it's the bond market, which all has interest rates payments on it. And you're not growing wealth. The interest rates alone are consuming the wealth, and then it starts to implode. And as it implodes, we have a fractional reserve banking system, which means every a dollar that you have, you can lend out 10. But in reverse, when a dollar goes away, you have to pull 10 back out of the system. And when you start pulling 10 back out of the system, that's an implosion. And so the central banks, and this is what this chart's saying, they have no choice but to print the money to offset that implosion. But it's somewhat like pumping a balloon that's got a hole in it. You're just pumping faster and faster, right?
Yes, and I think that what your slide here is showing us is that, as you said, the Fed has to keep asset values inflated in order to justify the idea that there's actually some collateral in the system. But what this slide is saying to me is the collateral is slipping away while the mountain of debt we're putting on top of the collateral keeps increasing. And that's a system that I would call self-liquidating. In other words, it's the dynamics within that system are going to liquidate the system.
You know, if you look at the collateral and the assets that have appreciated back on the left, the dot-com bubble, housing, we know the story there. We've been in, no question, a bond bubble. You pump these things up and they get overinflated and they have to come down. But what happens when they're overinflated? They're leveraged. And what we have is such a highly mispriced malinvestment and over-leveraged now going on that when the collateral values come down in the slightest, you've got this 10-to-1 reverse. We're not only running out of runway, we're running out of assets. And right now, if you look at equity prices, and I'm not talking about stock markets, I'm talking about the corporations themselves who have now got barely positive but to negative cash flows, which impact enterprise value. Equity values aren't growing, and if you don't have equity values that are truly growing, truly, not just a stock price, got other kinds of problems. But these continuous bond bubbles are nothing more than trying to hold up collateral values to stop this system from imploding.
And of course, for those viewers and listeners who aren't that familiar with technical analysis, that the megaphone pattern suggests that once you touch the top of the top rail, that it will return to the bottom rail, which is a considerable drop. And that's what, when Gordon and I have been talking about a market clearing event, that would be the result of a market clearing event.
And we have to have a market clearing event to adjust pricing, to correct pricing, to get rid of the malinvestment, because without it, you cannot have a recovery. People are not going to invest in things unless they know there's a good return in it, that they know that the risk is relatively reasonable to take. And that's our problem. The risk is way out of line. The prices are flawed. The risk is there because of currencies. And that's why the banks are not lending, because they can't find justifiable collateral to assume the risk. They won't lend it out on a non-revolving basis because they can't find sufficient cash flows to justify it. Corporations are not spending it in terms of capex or capital investment. Same kinds of reason. They can't find true organic growth. And until you clear it, you can't get a recovery. So all you're doing is you're really protracting it. That's what this chart is really showing here. And you expect it. And we've seen this megaphone top at every single major top going back 90 or 100 years that I've went through, and I've got studies on it, Charles, and I think I've got 11 major tops that all have the same kinds of patterns. But I need to make a point. This doesn't mean we're at the top right now. We're getting into that area. I happen to believe there's some more lift that's still available here personally. But for all intents and purposes, in the next 12 months, we're there at the beginnings of what we've always talked about is an adjustment in the entire global fiat currency system. That unsound money has led to this point. And this is a chart, Charles, we were talking about it. It's that I drew back in 2009. It says 2010, the bottom corner. And you can just see we're just tracking right along around on that sphere. And Japan is now front and center, as to be expected. I've been somewhat surprised that we haven't seen more problems at the state level. Look at Detroit, what's going on there. Look at Harrisburg, that's going on there. And we can probably go around. I think there's a lot of hidden bodies in the state area right now.
Absolutely.
The other question that it leads to, and I guess we all touched on it, has democracy therefore let us down, here because we haven't had proper governance? And does the democratic system really work? And I say that, look, austerity is required. Well, Europe has just completely thrown it out and walked from it. There's no way we're going to do the same in any country, any democratic. People do not want to take the medicine, which forces the politicians to wait for a crisis. Is this a corner that democracy leads us to?
It seems self-evident that it is. And as you have ably shown here in the previous slides, relying on the central banks to fix what is fundamentally a political problem is a failed policy, because the central banks can't fix the political policy problem. All they can do is expand credit and liquidity. And what we're trying to explain here is the more you expand debt and liquidity without fixing the underlying problem, the faster you're creating the ultimate crisis when the whole system implodes.
What have we learned then? What have we learned from global governance, crisis management, et cetera, in this failed, blown window of opportunity?
I think this is an excellent question, Gordon, because it highlights that the current global leadership appears to have learned nothing. They've simply done more of what has failed spectacularly for 5 years. I mean, I haven't seen any advance in understanding of economics or of finance, and I've seen no willingness to accept the political pain of real reform. I mean, have I missed something?
I would agree with you. I think that politicians, the good ones, see the problem, but they really are nothing more than a mirror of the public. And the problem starts with ourselves. We're not willing to take the medicine. We think there's a magic solution, a magic pill or something. When you run out of runway and there is none, then you have to take draconian actions, and we're not prepared for that. And we won't until we're absolutely forced. It's like your health. You should diet. You should exercise. You should stop smoking, et cetera, et cetera. But somehow, unless you're laying in that hospital bed in the emergency ward, you haven't taken it seriously. And then you're fighting for your life, and you swear, I'm going to do the following. And if you survive, you probably do it. But then about a year later, your weight's back on, you're back smoking. We just seem to be a species that has to have our backs against the wall before we will do anything about it. And democracy panders to that, unfortunately. I'm not sure what the answer is, other than very strict rules. And our founding fathers were very clear with the Constitution and the Bill of Rights of the rules that we had to stay within. And I think we've wandered from them all. And one of them is sound money, that how money has to be backed. And once you start on that road, this is what it all leads to. But even some of the things I'm seeing with the rule of law, we've had a number of shows on things in the Constitution that I think we're starting to bend on. Latest thing with the NSA and the whistleblower there of what's going on that people are unaware of. So you have to define rules, and you have to stay within them.
Yes, and I think we can also look at centralization as a key problem. That if you look at the Eurozone, it was basically driven by the idea that the more we centralize control and power, the more problems we're going to solve. And I would submit that the more you centralize wealth and power, the more problems you create. and the more you exacerbate the problems you have. So that's another dynamic. But yeah, I think your metaphor of being in the hospital after a heart attack is absolutely accurate. And I think we're heading for a financial heart attack. And the question will be what kind of how will we get through that, and will the financial system expire as a result of that heart attack?
Exactly.
And we don't know, but we'll be talking about it going forward.
Charles, great discussion. I hope our listeners enjoyed it as much as I did. We're going to break now. Could you tell our listeners how they could learn more about your writings and your work?
Please visit me at of2minds.com.
Okay. Talk to you later.
Thank you very much, Gordon.
Thank you. Bye-bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.